What's going on? Welcome back to another episode of The Mortgage Mindset. I'm your host, Trevor Otsuka. I am a licensed mortgage advisor with Barrett Financial Group, and I lend on commercial, residential, and private money for fix and flip. Solo show this week. We're going to dive right in. Today is Thursday, January 16th, 2025. And for your weekly mortgage rate update, 30-year fixed conventional, you've got 7.07%, 15-year fixed at 6.48%, 30-year jumbo is hovering around 7.35%, 30-year FHA is at 6.48%, and then the 30-year VA is right at the same amount. We did get some market improvement over the course of the last 2 days, which we are very grateful for. Consumer price index came in a little bit soft and the market rebounded. It was probably the best single market day since the election in November. So we are very, very happy about that, kind of clawing back some of the losses that we have had, that we've experienced over the last 30 days. Let's talk about the market for the week. All right. So for this week, we've had really the biggest one was the core CPI, which happened yesterday. Previously it was at 0.3%. The forecast was at 0.2%, and it came in exactly at 0.2%. And that was for month over month. But then for year over year, this is where it came in a little soft. It was previously at 3.3. All of the forecast was at 3.3, and it actually came in at 3.2%, which indicates that that is a deflationary event, and we will see some market improvement through bonds and treasury yields. Today, we had jobless claims, and then we also had retail sales. Retail sales came in a little softer, so we had another small rebound on the day. Okay, so if you look at mortgage-backed securities, you can see that the MBSs had about a 30 basis point or 0.3% improvement across the board. And then the 10-year treasury yield improved by, 4 basis points. Okay, so that's 0.04% improvement on the 10-year treasury. For next week, what do we got? Let's take a look here. Biggest day is going to be Friday, January the 24th. You're going to have S&P Global Services PMI for January. That'll come out at 6:45 in the morning. So I'll keep you posted on that. There's a 20-year bond auction that happens on Wednesday. Jobless claims again on Thursday, January 23rd. But really the biggest thing is going to be happening on Friday. So hopefully we will see really just some stationary movement. Hopefully the market doesn't move very much over the course of the next week, and we'll continue to get some loan applications in for this week. Now we're going to jump over to the news article headline. This is going to be from Housing Wire, and the title of the article is 2025 will be a year of non-QM player diversification. For those of you that are listening that do not know what a non-QM loan is, there are two primary categories of loans for residential loans. You have QM, which is called qualified mortgages. Qualified mortgages would basically be all of your traditional vanilla loans, as I like to call them. Okay, they're very plain Jane. They're not like Rocky Road or anything like that. They're vanilla ice cream. So that would be conventional, FHA, and VA. Then you have a whole nother category that is called non-QM or non-qualified mortgages. Think of these as more elaborate flavors of ice cream. Ben and Jerry's, all of their crazy flavors that they have, Rocky Road, the one that has the moose tracks in it with the peanut butter cups. That's what non-QM is, okay? It is just more flexible ways to present income and satisfy the income qualification requirement on a loan. A good example of this would be a business bank statement loan for a self-employed borrower that owns their own business. So they're benefiting from having tax write-offs at the end of the year because they own their own business and they can have a bunch of different expenses. But then when we go to qualify them using their tax returns, it looks like they don't make anything. They don't make shit on paper. So what can they do? They can go to the non-QM sector and they could do something like a CPA prepared P&L loan or a business bank statement loan, or they could buy a rental property with no income qualification using something like a DSCR, which stands for a debt service coverage ratio. Or if you have a client that has a ton of money in the bank, maybe they have $1 million that is spread across liquid accounts, checking, savings. They might have stock accounts. They might have cash value and life insurance. They might have retirements and 401ks. We can use all of that and come up with a qualifying number for monthly income based on how much assets that they have. And that is called asset depletion or asset utilization, just depending on what lender that you're talking to. So these are just to give you an idea of some of the products that are available in the non-QM space. And the key points that I pulled from this are growing appeal of non-QM loans to new players. Non-QM loans have grown from 3% of the mortgage market in 2020 to 5% in 2024. So that's almost double, driven by strong borrower profiles, low loan to value ratios, and stringent underwriting standards. So when you're looking at a non-QM loan, okay, compared to what we talked about earlier, which was one of those vanilla products, the non-QM sector usually comes with higher down payment requirements. So the lowest I've seen is 10% down. More often than not, you're going to be anywhere from 15 to 25% down payment, just depending on your credit qualifications. What's your FICO score look like? What kind of property are we talking about? What kind of product are we using inside of that non-qualified mortgage space? So those will all be determining factors on really what we're going to recommend for your minimum down payment on the deal. But on some of these bank statement stuff, you got really good credit, you could get away with 10%. Just your interest rate's going to be a little bit higher because it's more risk for the lender, right? Because it's not underwritten to the same guidelines as the Fannie and Freddie agencies and, HUD with VA and FHA, all that stuff. So insurance companies, traditionally hesitant to invest in residential mortgages, are now entering the market, attracted by the higher yield of non-QM loans as banks scale back private lending. Cumulative losses in the non-QM sector remain exceptionally low. It says less than 0.02% since 2018, further solidifying their appeal as stable investment vehicles. Role of deregulation in boosting bank participation. So this one's a little bit higher level. I'll try to break it down for you. It says deregulatory measures such as raising the threshold for systemically important banks and loosening risk-weighted asset requirements are making it easier for regional banks to invest in non-QM loans. So risk-weighted asset. They're going to review the physical asset, which is the property, and they're going to evaluate. A lot of these banks will have, it's almost like an AI, like a computer-based algorithm that they will put the deal details into, what kind of asset it is, what's the location. They'll pull the demographic information in the area, and then they'll run it through that risk assessment, and that's how they'll determine how much risk there is on the deal, and that can also impact what the interest rate is going to be on that non-QM product. You might see that more commonly if you were going in investing in commercial assets. Some of the banks, like private banks, I know for a fact that Bank of America Private Bank has a couple of different options. They'll do the SOFR plus prime plus a margin or whatever it's going to be, and that's how they get to your base interest rate on that commercial loan or placing the commercial debt. But they also have a risk-weighted assessment option that you can do if you're a very, very qualified borrower or a very strong sponsor on the deal. It says banks may favor wholesale loan investments, which offer better capital treatment and allow targeted exposure to specific geographic regions. The incoming administration's historical support for deregulation could further expand banks' opportunities in this market. Impact of insurance and bank entry on the market. The influx of insurance companies and banks into the non-QM space is expected to drive market growth and diversify the pool of investors. In my opinion, because I do a pretty good amount of non-QM loans, I think that is great. When I look at the underwriter guidelines for a lot of the non-QM lenders that are in the marketplace, their underwriter guidelines are extremely similar. And the reason why they're so similar is because after they fund the loan, they're going to then take that loan and they're going to sell it on the secondary market, just like a traditional mortgage. But there's only so many investors on the back end that are willing to purchase non-QM notes. Okay. So if we get a larger investor pool that's buying those loans in the secondary market, we may see some even greater flexibility inside of the underwriting guidelines that would help consumers qualify for loans using non-QM products. So that's the way that I would like to view that. It sounds very optimistic to me. So any time that we can get a little bit more flexible and we can help some people out, I think it's great. I think it'll be really good for the market. It says investment vehicles like separately managed accounts or SMAs enable insurance companies and banks to efficiently manage operational costs while leveraging specialized loan securities like Imperial Fund. The increased activity signals a strong year ahead for the non-QM market, with benefits for borrowers like entrepreneurs and self-employed individuals who rely on these flexible mortgage options. So again, if you're self-employed, if you own your own company, if you have business bank accounts, this is something that you could look at as soon as 1 year after owning your business, because most of the bank statement loans that we're going to do are 12 months. So you need to provide us 12 months of business bank statements. Some lenders are a little bit more flexible and they might say we only need 3 months of business bank statements, but we're going to require some additional supporting documentation. Your CPA may need to get involved. We might need to get a letter from them that outlines the strength of your company, how long that they've been filing your taxes, that the entity is in good standing with whatever state that the entity is filed in, so on and so forth. The other one that I really like for non-QM is the DSCR product. A lot of investors are using this because instead of using your income to qualify, we're actually going to use the market rent for the asset, for the property, and that'll substitute for the income. And we're going to get that from an appraisal. So we're going to ask the appraiser, hey, can you tell us what's the market rent value for this particular property? That's what we're going to use when we're qualifying the income. So if you guys ever have any questions about any of these things, my team and I definitely specialize in non-QM loans. These are fantastic for investors. I think that 2025 is going to be the year of the self-employed borrower, the self-employed home buyer. A lot of people that are entrepreneurs and own their own businesses, they don't even know that these products are available and can help them get into home ownership. So if you have any questions, reach out. Otherwise, I will see you guys next week. Peace.